All right. Good morning, everybody. So it's PPI this week, and that didn't exactly give us some great opportunities, but then today is CPI. So it's another opportunity for this gap close trade. We had non-farm payrolls last week. I talked about what we wanted to see. This is the outcome. It's what I call a liquidity gap. It's a nice trade. We get an opportunity to potentially play 3 times a month: CPI, PPI, and non-farm payrolls. So we have the possibility of having this trade. Whether we get it or not is something completely different. This is what a good one looks like. This is how we know it's one of those plays. Single direction push, a little bit of basing, and then we move back towards where that candle opened. And it usually gets back there around 11 o'clock. And this was last week's non-farm payrolls. Here's another example from another event. Single straight shot to the upside. It spent the morning working its way back down. It got there around 11 o'clock. This is what it looks like when it doesn't work. Big wicks in both directions. It's all over the place. And sure, it did go back down there and reset, but we would have traded it just as a normal day. We wouldn't have tried to trade it as a part of this strategy. Another example of what it looks like when it's not the right trade. So big wick on each side, just a lot of whip in each direction. If we get that this morning, we're done. We just don't trade it. So here's another one where we had the right push. It looked exactly like it was supposed to look, but by 11 o'clock, we weren't even close. And it just gave up. It no longer tried to close the gap, and it went and did something else. But until it failed, it at least made an attempt, right? So there was an attempt to close the gap. It just never materialized. Another example of when it doesn't work. And the reason I keep bringing up the ones that don't work is, to me, a trade strategy is more effective when you understand what it's supposed to look like, right? I don't like to use my stop to decide if my trade is good or bad. I want to make that decision long before it ever gets to my stop, and then just get out, if it's not working out the way it's supposed to. But one of those ways that I determine if it's working is that it looks correct. With this trade, we won't even pull the trigger if it looks like this, right? Because this isn't what we're trying to trade. So big wicks in each direction, forget about it. We're not trying to close the gap on that. And another example where it did work, and notice that we got back down there and got that gap closed by around 11 o'clock. It's not dead on perfect, but this is another true example of watch the clock. I'm telling you, so many things that happen in the market are just better equipped by watching that clock. It may sound arbitrary, like, what does 11 o'clock have to do with it? Who cares? You know what? I don't know why 11 o'clock has anything to do with it, but we can see that that's where it usually gets it closed, is around 11 o'clock, right? We don't have to have the why behind it. We just want to be able to recognize that that's one of the parts and pieces. It makes perfect sense, right? 9:30 open, you're watching the clock because you know that there's an event there. Today, CPI 8:30, you're watching the clock because you know that there's an event there. What about the events that happen every day that you don't know? And we can't know them all, but we can know what time it is. So watch the clock. It doesn't matter if the bar goes up or down, as long as it's a single drive in one direction without wicks on each end, then we have the potential for the play. Now, some people like to trade the entire move. I don't. I'm not interested in doing that. But consider the destination. If we're sitting way up here and you know that the destination is way down here, then you can continue to take short opportunities as they present themselves understanding that you've got opportunities to come back in and get another shot if you want, because we haven't reached our goal yet. So this is what's on the table today. The opportunity to close this gap if we get a gap. And what we don't want to see, something that looks like this. And you get this chance 3 times a month, something to consider, right? Because while it's not overly frequent, it is consistent. We do get these opportunities every month. And if you put more research into it, and you develop it out further in a way that suits you better, then you can personalize it and make it your strategy with your approach, trading it in a way that suits you better. So taking a look at what's going on around the world, we still got that stimulus push from China. Behind that, we've got the UK up nearly, well, let's say up 0.5%, a little more. The Russell this morning actually doing a lot of the leg work. If we don't shake that loose for PPI, we're going to consider that Russell lift this morning as a part of that rising tide scenario. So it's good to see the Russell up, and it's good to see it leading this morning, but it can't carry the load, right? The Russell's not going to lead the market. But it is a nice representation of the breadth of the market, right? If we want to see that rising tide instead of just the Magnificent Seven carrying the entire place, it'd be nice to see others get off the bench and get into the game, so to speak. And Russell's a nice representation of that. So if PPI doesn't wreck the entire show, having those small caps up this morning leading the way, that's a nice addition to a continuation. Then we've got Japan, the S&P behind that, the NASDAQ behind that, and dragging up the rear is the Dow Jones. The main thing here is that we're green on the screen around the world, and that's a good place to start. So if we take a look at Market Watch, this is my go-to for big events. They don't try to list every single economic event for the day. They only list the ones that they deem highly relevant. So it kind of cuts out the noise. The thing is about all these different places with all these different economic events listed on their page, if we put all of them together, we're still not getting all of the events for today. There's so many more than this. They're just not glamorous or sexy enough to hit the news and to be listed on a day-to-day basis. That doesn't make them less important, and they can be impactful. The problem is there's literally hundreds a day. Can't keep track of them all, and we can't know for sure which ones might or might not be impactful today. The good thing is we don't have to. We just watch the clock. It's lazy government. Half hour, quarter hour, new hour. Bonds open, quarter hour. The dollar opens, quarter hour. The market opens, half hour. Europe closes, half hour. Power hour starts on a new hour. You kind of get the idea, right? It's always a half hour, a quarter hour, a new hour. Watch the clock. And if you have any doubt on that, watch volume. Go to SPY, bring up a 1-minute chart. Go to the Qs, bring up a 1-minute chart. Look at the volume uptick at 15 minutes, 30 minutes, 1 hour. You can do it in the ES. You can do it in the NQ. Now, not every single time are you going to see a big flush of volume, because nothing happens all the time. But you'll start to get the idea that the clock is a lot more important and a lot more valuable than some $500 indicator that you bought off the internet. If you want to gauge the economic events for the day, FX Street is a good place to go. They have these boxes here on the side that will show you the historic impact of this economic event. Does it generally produce volatility or not? And the darker the box, the higher the history is for inducing volatility into the market. Volatility is movement. So if this says there's a high volatility impact, then there's a high movement. There's a historical precedent that then when this economic event happens, price moves big. Doesn't mean it's going to happen every single time, just that when this event happens, more often than not, we see big moves in the market. Today, it's all about CPI. But there's other things going on, like European Central Bank monetary policy meeting accounts, European Central Bank speakers. That's no different than having one of our Fed speakers or having an FOMC meeting. Now, this isn't their actual policy meeting, right? This is just the accounts. It'd be very much like our minutes. We do get some news tonight out of Japan. So, know what you own, so to speak. Think about what you're holding as we go into the close today and ask yourself if you're willing to hold that through a 3% move in SPY, which is what you could see in the overnight hours due to this kind of economic event in the overnight tonight. So Finance Juice is a good place to go in the mornings. It's a news aggregate, and it also has these economic events listed on the side. As a news aggregate, this is one of the few places that I show on a day-to-day basis that you really want an account. You want to get an account here so that you can filter what news you see, right? Because it's an aggregate. It's going to go out and it's going to grab news from all over the place. The thing is, a lot of news is just junk biased trash. That's the way it is, right? So, if you have an account here, you can turn some of that junk off. Fox News, CNBC, CNN. That's not what we need to keep track of, right? Turn that junk off. That way, what is left that shows up, that populates on the page is actually, market related material that offers some insight to what's going on. This is also a good place for when you see big moves and you're trying to figure out what just happened in the market that caused that move. If it's big enough to move markets, or if they think it's going to move markets, they'll put it in this red box. And oftentimes they'll connect it with a chart showing how the market moved after that event came out. And that chart links to TradingView so that you can click on it and it'll open up your TradingView account and you can interact with the chart from there. So pretty cool. So we're getting a lot of inflation data, not just today, but this week, and not just out of the US. So we got a whole lot going on. The CTAs are still in buy mode. We saw that yesterday afternoon when they activated the buy programs. It's non-discretionary, right? They don't get to choose. They're not timing their trade. They're not trying to, buy low, sell high, none of that. They just have to purchase X amount per day, and there's nothing that they can do about it. They're not done yet. There's the spot gamma levels for today. The 1-day implied move is 0.76. That's in the SPX and in the SPY. So if we expand beyond that a considerable amount, it's very likely that they'll buy into buying or sell into selling. Otherwise, that's very likely going to be the range according to optionality. I leave this page up for a moment so that you can take a screenshot and you'll have these levels for the day and you can take your time laying them out on your chart without feeling rushed. All right, so we got crude off of that 94. We're on a daily chart. But if we bring it over to the weekly, that 94 level starts to make a little bit more sense, right? Now, we spent most of the year down here. We had a nice clean range. Things were going great. We finally broke out of that range. But the thing about a range is it kind of gives us what I call a Busby. And I know a lot of people have struggled with that concept, Busby. But if you read a lot of textbooks, it talks about how when price is in a range and it's bumping against that range and it finally breaks out, a lot of times it will come back and it will validate the old resistance as a new support before it begins moving to the upside or the downside. So knowing that when price is in a range fighting resistance and it finally breaks that resistance, it's very likely going to come back and test that old resistance as a new support. That's a lot of words to say. Why not just give it a name? So that I don't have to sit there and say over and over again, price was testing resistance, broke through it, and now it's going to come back and test old resistance as new support. It's a Busby. So we're just looking for price to retest that support, because that's what price does. Now, you could consider that a tradable opportunity, but it only owes you back to the top. And this one is a reasonably decent move. I got to say that this one's nice. But a lot of times when you get the breakout, it's just a very small move away from the breakout zone before it comes back. And people think that that's the trade. And sure, okay, but if it's not a very big move, then it's not very much of a trade. This entire concept is suggesting that now that we've gotten out of this big range here, that we're finally going to start making moves. And some of the greatest trends in the history, you go back and look at your charts, most of them started with a range bound market that broke out and pulled back to that old resistance, tested it as support before starting this magnificent trend. So the Busby kind of implies that the range is done and we're now doing something else. Maybe we're going to start trending. It only owes us back to the top. From there, we'll just deal with the fact that it's a really big cup with a handle, and we'll be looking for the measurement of that cup, 50%, and then 100%, which gets us back up to this zone here. It's easy enough, which, by the way, would then be a bigger cup, because that's the way it works, right? You can see the little cup right there, the bigger cup right there, and the next bigger cup right there. Isn't that cool? Yeah, I'm a nerd. I know. So we got gold. It's trying to make moves back up again. That 1800 level, they're doing quite a bit of defense on it. They front run that thing the other day. It was kind of impressive. But remember that a good double bottom needs to go through the previous bottom because liquidity resides on the other side of the pivot. Get the t-shirt, right? Liquidity resides on the other side of the pivot. So we need price to go through that line and come down here some, like 1775 area. Otherwise, it's not a double bottom. It was a potential double bottom, but they took a front run on this and started running it to the upside, which sadly still puts us in a bearish tone here. And we're now looking for the next leg down back to that 1810 through that to begin the double bottom. Now, there's plenty of times throughout history where we don't make contact down here. We don't get the double bottom and we still go up anyways. Sure. So, there's no guarantee here, but statistically, since they took a front run on this, we're just pulling up before another run down. And here's an example of that. Classic double bottom setup. They took a front run on it, ran it back to the upside. And how'd that work out? We went down anyways. right? So that's kind of the idea behind it. So this pushing gold, we're just looking for that to be, a minor pop, a rally into resistance before rolling over and going lower. You can correlate that in an inverse way with US dollar Japan. With this rising, we expect US dollar Japan to go to the downside. Should be able to play the same thing with gold miners or GLD or silver, all of those with the same thing. As long as we've got US dollar Japan heading to the downside. Now, I'm on a weekly, so, this is a bullish weekly candle, but we are inside last week's candle. We want to mark out that 50%. If we're going to keep this bullish move, it needs to close above this 50%. Otherwise, that's the first warning. Now, we are in a topping pattern here, and topping patterns can last for a long time, especially on a weekly chart. It could take months of just sitting up there chopping about. But we've got some clear defined levels. We've got the previous week's candle as our number one source of information right now. So the high, the low, and the 50% mark. It's very likely if we break above that 150.16 and we start challenging this high, that Bank of Japan is going to do what they threatened that they were going to do, and they're going to intervene. There was some thought that they had intervened earlier, but someone sent me the article. I went and read it. It's from Bloomberg, so it's a trusted source, as much as it can be. At least it wasn't Joe Schmo's news service. And every indication shows that US dollar Japan wasn't making moves due to an intervention from Bank of Japan. So they have not yet intervened. Don't know what that was, but it wasn't an intervention. So that's still on the table. And since this continues to look bullish, we're still looking for that breakout above 150. This is the 10-year from Japan, and that is a magnificent move this morning. We don't know where it's going to go with this whole thing yet, but this is one thing that I'm going to be watching through most of the day today. I want to see as we get past CPI, because right now the markets, when I get to Thinkorswim, you'll see they're sitting out. So we're not seeing much of a move in anything because we've got CPI on deck, which means the market's not reacting to this yet. And so we don't know how this move is going to affect the markets yet. But after CPI, the markets should start responding to this as well. So this is one thing I'm watching today closely. It's the 10-year from Japan. We can see the China ETF is up. So just like when we use the KWEB, we can use this as a gauge for those China ADRs, JD, BABA, Baidu, PDD. If this is up, those should be up. Of course, with CPI, that takes precedent. All right, this is a lot of noise. I get it. There's a lot of stuff going on here. But one thing at a time. The volume is really light. All right, not crazy light. 80 down here is close to the lowest value that we would want to see. And if you ever go in on a morning and you haven't checked the news yet and you see the volume this light and you don't know if there's an event, you should be concerned. Now, I always check the news every morning, so it's just a part of what I do. By the time I get to Thinkorswim and I see this low number, I already understand why it's low. But if we didn't know and we see this low of a number, it's a warning. Hey, something's wrong. People are sitting out of the market. The market is waiting for something. And we know what they're waiting on. They're waiting on CPI. But if you didn't know, you'd want to go look. Why is the volume so light? You better go look around, see what they're waiting for. And are they cautious waiting or are they nervous waiting? If they're nervous, they're hedging. Now, when I came in here to do my own trading this morning, this market maker move wasn't here. It showed up in the last 40 minutes or so. So they're hedging now that we're getting closer to CPI, but they weren't hedging earlier this morning. So we have a market maker move on top of our regular average daily range, which is around 1.3%. We're inside day breakout. We've broken out of yesterday's range. We've got a megaphone pattern, which just shows expansion. We're stuck in a range, but the range is widening every time we make another sweep. Liquidity resides on the other side of the pivot. So this was the pivot. We overshot it. That was the pivot. We overshot it, right? That's kind of the idea. We're getting a wider and wider range until finally something snaps. And that's probably going to be CPI. We got the 10-week underneath us at the cog line 44.11. We've got the 20-week above us 44.39. We've got the 10 period, another 10-week, right? One's the EMA, one's the SMA. We got the SMA at 44.22. We can see the impact from the SMA right there, for an example, or here when we were hovering around it. But now that we've crossed through it a few times, it's lost its respect, right? It no longer has such a value to it. First touch play is fantastic, but unless you were trading last night, you didn't get to take. So what? We do have an MDP, missed daily pivot. It's this daily pivot point down here. That doesn't really have an impact on us today. It will matter more tomorrow. If we come in tomorrow and it still survived as a missed daily pivot, then it has weight. Right now, it's just something that we point to and recognize. The weekly pivot point is way down here. Generally speaking, it's not a good idea to get this far away from the weekly pivot point. We tend to get mean reversion when we get too far away from it. I don't have a number for how far is too far. I just know I get a little nervous when we get that far away. So I did mention that there is just a lot of trash here, right? There's just a lot of stuff on my chart, including these gamma levels and spot gamma levels. And some of them have more value or more impact or more weight than others. This volatility trigger is a really important level, and we're a long ways from it. Generally speaking, we're bullish above, bearish below. But the same could be said for that daily pivot and for the weekly pivot. Another line worth noticing is last week's high. It's down here. It's at the ADR full. The ADR today says we could go 1.3%, and we'll add the market maker move. That would be 1.46%. You might as well just say 1.5. So that's a 1.5% move from where we closed or from where we opened, whichever way you want to do it. I like from where we opened. So that says that we could easily go to 44.76, or we could easily go to 43.59. And as crazy as it sounds, we could do both today in the same day. Wouldn't be the first time. This is everything we've got on the table today, including my precious 30-year bond auction. I like that one. It's one of my favorites. Not supposed to say that though, right? It's like saying you love one of your dogs more than you love the other one of your dogs. You're not supposed to say that. Oh, and I got my cat sitting here giving me stink eye for that. So, next time I'll do a cat analogy. 8:30, 10:30, 11, 11:30, 1 o'clock, 2 o'clock. It's a full house. Nearly every hour today has something going on that we know about. Not to mention what I had already mentioned earlier, right? That watch the clock, because there's a ton of events that aren't listed here that are happening every day. Things like grain shipments out of New York Harbor. Serious, that's an event. It's a recordable economic event. That and so many others that just don't show up every day in the news. Usually because most of the time they don't impact the market. But statistically, if you have hundreds coming through every day, and randomly some of them can be impactful, even mildly impactful. Watch the clock. Even from the idea that when they like to dump news on us, like they did the other day when the markets were sitting up at the highest point of the day and we suddenly dropped like crazy because some news came out. It came out right on the hour, right at 1 o'clock. The White House, for an example, likes to dump news in the later part of the day on Fridays. Lazy government, they'll do it on the hour, on the half hour, on the quarter hour. 10-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. Hey, look, we're at the highs. Mostly got a classic D shape here, but if we continue to hold these highs, we could build out a B shape. Breaking below yesterday's low will drop us through an air pocket, but it's worth mentioning that we fell through that zone the other day and we found support down there. Now, my argument is we really didn't find support in the ES. It's very likely that an inverse product hit resistance, and as that fell, this rose off of that level. That's my argument. Now, which market, I don't know. But when we see the ES turn on a dime and flip the other direction and start running and it didn't hit a pivot point, that's usually my first argument is we didn't. Don't go looking for a pivot point that you weren't able to find. It very likely didn't hit a pivot point at all. An inverse market that's correlated with us hit resistance or hit support, and it moved, which made this move and turned us around. I know, I get it. It's like 3D chess. So we do have a VPOC now, a new one. It's from yesterday. So if we do make moves to the downside, 43.92 area, which has been an area that we continue to talk about. It's one of those major pivots, right? Monthly level, weekly level, yearly level. This is a biggie. That 43.92, 43.93 area. The crazy thing is, if we're above it, we're bullish on the bigger picture, not just for the day, right? For like swings and stuff. So if we do make moves to the downside today, that's going to be one of the targets. And for me, I'm going to be looking for a first touch play on that. Look at that turnaround yesterday. It's fantastic, right? Put it on a 1 minute chart and look at the volume right around the hour and the quarter hour. All right, so there's really no reason to dig through what's up and what's not up, because the CPI is going to change everything. It's either going to affirm all of this and we're going to really go to the upside, or it's going to wipe all this off the table and we're really going to go to the downside. So that's the biggest thing for the day, right? That's CPI. It all comes down to that. I was talking yesterday about trading options on the futures. I do it from time to time, especially when I don't have anything else to trade at the time and I want to tie up some capital just to be able to use some of that capital. Selling options on SPY requires a very large margin account. Selling options on the SPX requires a really large margin account. It's kind of prohibitive. But selling options on the S&P through the ES futures does not require such a large margin account. Around a $20,000 to $25,000 account can do ES options, selling a put or selling a call naked. For a $5,000 account, you can do MES options, the micros, selling a put or selling a call. And you might be thinking, why would I want to do that when I could do a call spread or a put spread? I could sell a call spread, sell a put spread on the SPX or SPY. That's true. Although the SPY really probably won't pay you very much for the areas we would target, the SPX might. So the question becomes, do you think we're going to go to 4,200? I know I cheated. I didn't put a date on it. You think we're going to go to 4,200 before Halloween? What about Thanksgiving? You think we're going to get there by Christmas? So if you answered no, sell a put at 4,200. That's it. See how simple that was? Take it the other direction. You think we're going to go to 4,600 by Halloween? 4,600. You know where that's at, right? It's the top of the chart. You think we're going to get there by Thanksgiving? What about Christmas? No? Sell a put at 4,200. Sell a call, 4,600. The farther out in time you go, the more credit you'll get. If you don't like the amount of credit that you're getting, you can sell more than one. If your skill and analysis makes you comfortable with it, get closer. Answer that question another way. You think we're going to get to 4,500 by Halloween? No? Sell a call at 4,500. You see how simple it is? You don't have to make things complex. Think we're going to get to 4,400 by Thanksgiving, by Christmas, by Halloween? Sell a call at 4,400, 4,300. Sell a put down there, sell a call up there. Depending on the size of your account, you can use the MES or you can use the ES. And you want to do the trade naked for a number of reasons. One is if price begins moving against you, the margin requirement will change drastically. So one of the ways that you can defend the trade is just to buy a call if you sold a call, or to buy a put if you had sold a put, because now suddenly you have a put spread or you have a call spread, and it completely eliminates that very large margin requirement. It suddenly just puts you in a spread. So it's a way to defend the trade. Start naked. And sure, you can do it in the SPX or you can do it in SPY, but SPY, there won't be any credit at those levels. There's just no premium that far away. And in the SPX, there might be, but you're going to need a really large margin account to be able to sell a naked SPX option. You don't really want to do it in the NASDAQ because options on the futures aren't really liquid to begin with. And in the NASDAQ, it's really not liquid. The ES is your best shot. Most brokers don't like complex option spreads on futures. So butterflies and diagonals and, well, diagonals and counters, maybe not so bad, but definitely, iron condors, butterflies, things like that, they won't let you do it. You'd have to individually put together each piece, and they still won't trade it as a butterfly or as an iron. Most of them won't let you roll as a group either. You have to individually roll each leg. So you can see how trying to manage the trade becomes more complicated. But if you just start with a naked option, like selling a call or selling a put, and then you get in trouble with a margin call, simple solution, just buy a call or buy a put. It's worth thinking about anyways, right? All right, guys, watch the clock. We got CPI in about 15 minutes. And from that, we ought to get the rest of our day going. Keep in mind what we're working with here. Between now and the end of the year, there's a big looming question. Are we going to be closer to 4,600 or 3,800? Because that's, like the big argument here in the bigger picture. My argument has been that we're going to be closer to 4,600 than 3,800 by the end of the year. That this is nothing more than a pretty good size pullback before going right back up to that high. And that's how I'm positioned in my portfolio. If I'm wrong, well, we'll know soon enough. See y'all tomorrow.